Somewhere, right now, your money is quietly shrinking. Not disappearing overnight, not vanishing in a dramatic market crash, just slowly losing power. You can't see it happen. There's no notification, no warning message, no bill in the mail. But every year, the same invisible force takes a slice of your wealth. And the strange part is, most people never realize it's happening. Because unlike normal taxes, this one isn't announced. It isn't voted on in public debates. It doesn't show up on a receipt. Yet it quietly affects almost every dollar you earn, save, or invest. Economists have a name for it: inflation. But calling inflation a simple rise in prices hides something much deeper, something much stranger. Because when you look closely, inflation behaves a lot like a tax that everyone pays, a tax that no one invoices, and a tax that governments around the world quietly rely on. To understand why, we need to start with something that feels almost absurd: money itself. Because money isn't really money, at least not in the way most people imagine. If you open your wallet and pull out a bill, it feels real, solid, valuable. But the value of that bill isn't inside the paper, it's in the system behind it. For most of human history, money was tied to something physical: gold, silver, sometimes even shells or grain. If you had a gold coin, it had value because the metal itself was scarce. But in 1971, something historic happened. The global financial system quietly changed forever. The United States ended the gold standard, which meant the dollar was no longer tied to gold. And because most of the world's financial system revolved around the dollar, the entire global money system slowly shifted with it. Money was no longer backed by a physical resource, it was backed by something else: trust. From that point on, money could be created by financial systems and central banks when needed. Which sounds harmless at first. After all, growing economies need more money to function. But here's where things start to get strange. Because creating new money doesn't magically create new goods, houses, food, or energy. It simply increases the number of dollars chasing those things. Imagine a small town with exactly 100 apples and exactly $100. Each apple costs $1. Now imagine someone suddenly prints another $100 and gives it to people in town. The town still has only 100 apples, but now there are $200 competing for them. So prices rise. Not because apples became better, but because money became more common. This is inflation in its simplest form: more money chasing the same amount of stuff. And when this happens across an entire economy, prices gradually drift upward. A coffee that cost $2 becomes $3. A house that cost $200,000 becomes $400,000. Groceries, rent, transportation, slowly climbing year after year. But here's the subtle twist. Inflation doesn't just raise prices, it quietly lowers the value of money itself. Which means every dollar you hold today buys slightly less tomorrow. And when that happens consistently over time, the effects become enormous. Consider the US dollar. In 1970, $1 had the purchasing power of roughly $7 today. Which means the dollar has lost more than 85% of its value over the last half-century. Not overnight, just gradually, almost invisibly. 2% here, 3% there, but compounded over decades, that small annual erosion becomes massive. And this is where inflation starts to resemble a tax. Because if the purchasing power of your savings falls every year, you are effectively losing wealth, even if your bank balance stays the same. Imagine you save $10,000 and leave it untouched. If inflation runs at 3% annually, after 10 years, your money still says $10,000 on the screen. but its real buying power has dropped to about $7,400. Nothing was taken directly. No government bill arrived demanding payment. But the result is the same. Your wealth shrank. Now multiply that effect across an entire population, and suddenly inflation starts to look less like a side effect of economics and more like a structured redistribution system. Because inflation doesn't affect everyone equally. Some lose, some gain. And the winners are often the people closest to the source of new money. When central banks expand the money supply, the new money doesn't appear everywhere at once. It enters through financial institutions, banks, government spending, and asset markets. The first recipients can spend it before prices fully adjust, which means they get the benefit of the old price levels. But by the time that money spreads through the economy, prices have already started rising. So later recipients, wage earners, savers, pensioners, face higher prices without receiving the early benefits. This phenomenon has a name, the Cantillon Effect. And once you understand it, inflation starts to look less like a random economic event and more like a structured transfer of purchasing power. From later receivers to earlier receivers, from savers to borrowers, from the public to institutions. Which leads to one of the most counterintuitive facts about inflation. It actually helps governments manage debt. Because debt is fixed in nominal dollars, but inflation slowly reduces the real value of those dollars. Imagine a government owes $1 trillion. If inflation gradually cuts the purchasing power of the currency in half over time, the real burden of that debt effectively shrinks. The government still owes $1 trillion on paper, but those dollars are worth much less. In other words, inflation quietly erodes the real weight of debt, and modern governments carry enormous debt loads. The United States alone has more than $30 trillion in national debt. Across the world, the total is far larger. Paying it down directly would require enormous taxes or spending cuts. Politically painful decisions. Inflation, on the other hand, spreads the cost slowly across the entire population, quietly, without a vote, without a headline announcing the bill. Which is why some economists describe inflation as the most politically convenient tax ever invented. It funds spending indirectly, it reduces debt burdens over time, and because it happens gradually, most people never connect rising prices to monetary policy. But the story gets even more interesting when we look at how inflation interacts with modern lifestyles. Because today, most people don't hold large piles of cash. They hold assets, homes, stocks, retirement accounts. And inflation behaves very differently across these categories. Cash loses value, but assets often rise in price during inflationary periods. Not necessarily because the assets became more productive, but because the money used to buy them is worth less. This creates a strange dynamic. People who already own assets often see their wealth grow during inflation, while people trying to save money for the first time watch prices move further away. A house that once cost 5 years of salary becomes 10 years, then 15 years. Not necessarily because houses improved dramatically, but because money changed. This dynamic helps explain one of the most confusing economic trends of the past few decades. Asset prices have surged. Real estate, stocks, collectibles, even art. While wages in many industries have grown much slower. The gap between asset owners and non-owners widens, and inflation quietly plays a role in that divergence. Because the invisible tax hits idle money hardest, cash savings, fixed pensions, low-interest bank accounts, while leveraged assets, things purchased with borrowed money, can actually benefit. If you borrow money at a fixed rate and inflation rises, the money you repay in the future is worth less than the money you borrowed. Which is why corporations, governments, and wealthy investors often carry large amounts of debt. To them, inflation can act like a slow discount on what they owe. This flips a common financial belief upside down.
Most people are taught that debt is dangerous and saving cash is safe. But in a moderately inflationary system, the opposite can sometimes be true. Cash slowly melts, debt slowly shrinks, and the people who structure their finances around this reality often end up far ahead. But here's where things become unpredictable. Inflation is supposed to stay controlled. Most central banks aim for around 2% each year, low enough to feel stable, high enough to erode debt gradually. It's a delicate balancing act. Too little inflation can freeze economic activity. Too much can spiral out of control. History is full of examples where that balance broke. In the 1920s Germany, hyperinflation became so extreme that workers were paid twice a day so they could spend wages before prices